Okay, good afternoon, ladies and gentlemen, and welcome to today's edition of HFM's Friday Webinar Live. Thank you for joining. Apologies, I had to quickly make sure my recording was in order and I did not have any notification, popping up on my screen. But welcome, welcome, welcome. I can see amazing people on the live right now. How is everybody doing in the session today? Today we are talking about a very, very interesting topic. It is, intraday trading and swing trading strategies. Intraday trading and swing trading strategies. I mean, quite interesting topic, quite broad as well. We're going to try to fit it into, just 1 hour, maybe 1 hour plus. We're not going to do too much, right? Intraday trading is not something that is new to us. Neither is swing trading something that is entirely also new to us in this particular market. We're just going to offer some interesting insights, something to, help us get better in what we do in the market. And I want to start from a certain place. And that would usher us into what we're about to discuss in the session today. And where am I starting from? I'm starting from the point where, as traders, we absolutely, absolutely need to understand where we are. We need to understand the kind of trading that we're interested in doing. We also need to understand how we intend to approach the market. We cannot all approach the market in the same way. It's not possible for us to approach the market in the same direction. In fact, one thing about the market is you must choose what works for you. It is something that I will always say, every single time, to people. You have to create your own, model for yourself. It's okay to ask someone, oh, please, what model do you use? How do you approach the market? How do you intend to make decisions, or how do you come about making decisions in the market? And this person goes and this person says, oh, I love to focus on technical levels. I always love to focus on technical patterns, see what the chart is saying, see what the chart is saying in terms of who is in control, is it buyers, is it sellers, look for candlestick formation as confirmations and whatnot, and then try to use that to enter into the market. And then someone else says, oh, well, on my own point of view, I'm trying to, focus more on sentiment. I want to see how the market is doing. I want to see what the market is doing today. Is the market positive? Is the market negative? I want to see what I'm supposed to be trading. I want to see what I'm supposed to be buying, what I'm supposed to be selling. And then I want to approach the market within that particular environment. Another person says, well, for me, I think the most important thing is fundamentals. I want to see what information is saying. I want to see what, central banks are saying. I want to see what data is saying. I want to see what economic events are saying. I want to see what, is coming out from these nations. And I want to use that particular information to determine what I'm going to be interested in trading in the market. Another person comes and says, for me, it's a combination of everything. I want to know what sentiment is saying. I want to see if it marries what fundamentals are saying. And then I'm still going to conduct or try to confirm with the technicals to see how I am expected to go into the market. And then you see different point of views, different set of people, different school of thought. I've just mentioned about four. There are other ones, but the idea is there's not just one single way into the market. And despite all of this school of thought, it is still down to you to decide what works for you. Does it work for me to trade only technical analysis? If it does, please go ahead. You see, you can't come to me and say, what should I use? Should I focus on technicals? What if I tell you that no? Does it mean you just listen to me and you just forget technicals and say, since my mentor said no technicals is over, since Mr. Emmanuel said no technicals is over? Or if I say, you say, can I use fundamentals? I say, no, 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 focus on technicals. You also throw fundamentals away and you stay only on technicals because you think I have authority over the market. You see, one thing I need you to understand is you have to find what works for you. If what works for you is technicals, you have to stick with it. If what works for you is sentiment, you have to stick with it. If what works for you is fundamentals, you have to stick with it. If what works for you is a combination of all of those factors, you have to stick to it. And now the thing is, how do you know what works for you? The only way you know what works for you is by trying them, which means you have to be in the market. You have to be in the market trying those school of thought out, using it to trade, and then using a data-based approach to determine if they're working for you. What do I mean by a data-based approach? I mean by looking at your history and seeing, okay, when I was using this particular strategy, this is the number of trades I won, this is the number of trades I lost. Oh, when I was using this particular strategy, oh, this is the number of trades that I was able to win, and this is the number of trades I was able to lose. Oh, when I was buying, I made this amount of money. When I was selling, I lost this amount of money. And that way, you would be able to make an informed decision in regard to what works for you in that particular light. Now, that's on one side. Now, on the other side, the trading style also is quite important, and you must choose what works for you. You see, when it comes to trading and when it comes to the style to which you can use to trade, in the Forex market, some of the most popular ones is scalping on one extreme end, and in another extreme end, we have position holding. I'm calling them extreme end. Why? Because for scalping, you're staying into the market, short. In fact, if there's anything more than short trading, like holding trades for a short period of time, for the shortest period of time, looking for small moves, but big profit. Yes, the purpose of scalping, because a lot of people don't know that the purpose of scalping the market is not it's not just because you're staying for the shortest period of time. And I usually like to call this Nigerian scalping. The Nigerian scalping is the scalping of, let me just quickly go in and quickly come outside without, worrying about the market. So I can go in and I close it in five seconds. I've scalped. Well, the purpose of scalping is to actually go in, for the shortest period, but you are actually looking for just a small move, a small bounce, but you're making big profit. Why? Because scalpers naturally tend to use big lot sizes and they can't hold it for too long, which means if someone is trading like a 5.0, where every single peak movement is about $50, do you think you want to stay there from morning till night? No, if he gets the first 10 pips, that's $50 in 10 places, $500 in 2, 3 minutes. Do you get what I'm saying? Quickly, small moves, short period of time, big profit. Now, on the other hand, position holding necessarily does not mean you're going in for the biggest profits, but you're looking to catch the biggest moves. Over a long period of time, which means naturally for me, someone who is position holding either a big lot size or not is probably looking to catch a big move, like trying to catch in like 500, 1,000 pips. He knows that it's not going to come in handy over 2 minutes or even one day, especially in the currency market, right? He probably needs to hold on to that particular trade, over a long time. And usually position holding requires, holding a trade for minimum, at least, barest minimum must be at least 2 weeks, and it goes into a month, maybe a few months if you can. So they're like two extreme ends, two really extreme ends. One, you're going in so quick, small moves for big profit. The other one, you're going in, you're staying in for a long time to catch really big moves that could also be really big profit, at the end of things. Now we have, some in the middle also, which is somewhere around, well, day and intraday, they're not so far off, right? Eventually, a lot of people think the intraday and day trading are quite, different. But I hate to bring it to you. They're not that different. In fact, if you have time, maybe after this session, just go to your browser and type in day trading on one side and type in intraday trading on one side. You'll be bewildered at the definitions you see on every search you're going to get. It's going to say the same thing. And what is it going to say? It's going to say trading, looking to take advantage of the market over a single day. They put it over a day, like saying you're looking to get in on some short-term moves, but you're keeping whatever you're doing to a day or to the close of business in one particular day. But one way or the other, we've tried to stretch intraday trading, saying you could hold it for maybe 42, sorry, maybe 48 hours if you can. But usually it's naturally expected to be within a day. So we have day or intraday trading as the case may be, and also swing, which is just in the middle of the park as well. Now, the major difference between day trading or sorry, intraday trading and swing trading is how long you're holding the trade for. Now, for intraday, you're probably holding in for at most 24, at most 48 hours or thereabout. For swinging, you're probably looking to be in that particular market for maybe a week, say Monday to Friday, say Monday to Friday, maybe a week. Say you're like locking in a position on a Monday and you're like, I'm not closing this until Friday. Now, think about it. If on one side, intraday talks about looking for opportunities within a single day, and the other one talks about looking for opportunities and actually holding on to that opportunity for at least a week, are they necessarily the same? Would they require the same? No, HFM is not against scalping. You can absolutely scalp on our website, on our platform. In fact, it's on the website. You can absolutely scalp on HFM's website. Absolutely allowed. It's not going to be flagged for anything. For anything, it's allowed. Now, like I said, are they going to be the same thing? Is intraday going to be the same thing with day trading? Would they have the same methodology or would they have the same, process of making decision? The question is, the food that you're going to cook that would take, you know, 20 minutes, maybe 30 minutes or thereabout, cannot be the same necessarily with the one that you're going to cook for maybe 2, 3 hours. You don't expect that they take the same energy or they take the same attention because already there's a time difference. And nonetheless, it means we cannot help but say that intraday trading is still a short-term trading when compared to swing trading, which is like a mini long-term trading, because it's still long, but maybe mini long-term. Because at least if you're keeping your trade for at least a week, you're still swinging. If we go beyond the week, once it goes beyond the week, if it gets into 2 week minimum, 1 month, then you're already position holding. But yeah, it's more or less like short-term trading versus, mini long-term trading. Now, the question is, what kind of analysis fits short-term trading? Think about it. If I'm going to trade within a day and I'm looking to take advantage of opportunities within a given day, over time, and then make sure I close it before the end of the day, I don't want to carry over into the next day. Or even if I carry over into the next day, it must be because my profit target is not achieved. And I think it could be made before, the start of, the next day or before the European session or the American session the next day or something. Listen to this. In that environment, I need to get something that can move price in my favor over that particular period of time. And one of the most potent analyses for short-term trading is sentiment, because sentiment on its own is naturally short-term trading. Why? Because you see, you bear me witness, it is absolutely not easy to maintain the same mood from morning till night, even as a human being. I mean, if you don't absolutely wake up shining teeth, I mean, I'm not saying you're sad, but nobody just opens their eyes from bed and goes, and starts smiling. I mean, come on. You're probably going to ease into it. As at that time in the morning, you're feeling different, right? You're just like, okay, you just want to go about your day. You want to go to the bathroom. You want to get prepared for work. Maybe even work is always stressful. So already from the beginning of the day, you're not looking to, happy or there about, right? But maybe as your day goes by, some good news from somewhere, positive news from somewhere, positive review from your boss or something, or your kids came up with some positive report card or something, your mood is lit up. You're happy. You didn't start the same way, right? Before night, you could go up to bed feeling indifferent again. So naturally, sentiment being mood of the market also means the fact that mood cannot be sustainable for a long period of time means it actually fits the bill for short-term kind of trading. Now, on the opposite side of things, if I'm going to conduct a meaning long-term trading, right, and it has to do, with sentiment, listen to this, it has to be a global sentiment. It cannot be a normal sentiment. I'm not saying sentiment cannot help you with intraday trading. I'm only saying it cannot be, a simple sentiment that you're seeing from, a website. For example, we have a sentiment website, which means a website you can easily go to, check what sentiment is saying, what's it reading, is it reading positive, is it reading negative. You don't care too much about if it is caused by one thing or the other. In fact, you don't even take the time to check what is causing it, as the case may be, right? That's a different case. But you see, if you're going to trade swing based on sentiment, it must be a global sentiment. And we've had multiple global sentiments recently. For example, in the beginning of the year, one of the major global sentiments we had was the tariff debacle between Trump and the rest of the world. As at that time, that's a global sentiment that is not going to be it's not going to be it's not going to be like how do I put it, short step. It's not going to be happy now, sad later. It's a global sentiment, which means at the time, it was more or less like fixed. The market was negative for as long as we could remember, which means we could have locked in a particular direction, saying because of this particular factor, until something changes, it should remain in this particular direction. So I start my week, and the first thing I'm seeing on my week is Trump announces 90% tariff on blah, 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 blah. I know already it's the beginning of problem. I know that the week is already going to be laden with all of this nonsense. I'm absolutely, convinced I'm having negative market for the rest of the week. I lock in a direction only for the next 4 5 days. That's swing trading. So you could also still trade sentiment with swing, but the difference is it's not going to be a random sentiment. It's not going to be a sentiment based on one key data. Oh, we saw information from China. Oh, PPI was stronger than expected. Oh, you now say, oh, market sentiment is positive. And then you pick up that positivity and you say you want to swing with that. Absolutely not. It wouldn't work. But a global market sentiment, one to which you can say, this is what is happening in the market right now. This will determine how the market should move for the time being. That works. As at the time when Russia launched their first attack on Ukraine, that was a global market sentiment, right? Tariff, also global market sentiment. Iran and Israel right now could be a global market sentiment, all things being equal, depending on how we see information, build within this particular weekend up to the fresh week. If they still remain in the news up until Sunday, under normal circumstances, it means the coming week would, I'm not saying for sure, but also be tainted with elements of negativity, because I've been on social media since morning, I've been on Twitter since morning, and one of the major things I've been seeing is, tweets from Iran's, official handle talking about how, oh, they never started this war, so nobody can, call anything on them. In fact, I think Heritage also sent me one. I mean, that tweet was, spot on, crazy. And it was just a straight tweet. It says, remember, we didn't initiate it. That's interesting, right? So, and that's a tweet from someone who is saying, if I start my own, don't say I started it. That's what they're saying, right? So it means if it develops like this over the weekend and also Sunday night, and we're still hearing whispers, 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 I mean, that's expected that we might see what we call a dominant global theme. So a global dominant sentiment is something that could absolutely, absolutely work in our favor for swing trading, especially if it is dominant. I mean, I could show you, for example, the dominance of the old tariff debacle up until something changed in recent times, especially looking at the dollar part of things. And that means we have to just quickly look at the equities market. And you'd see, for one, the fact that, let me just change my time frame a little bit and look at this. And then you see the fact that over time, when the whole tariff problem started and the whole tariff debacle actually started, in recent times, you saw that there was only one singular directional movement on the US 500. See, down. It was down. The movement lower for multiple days. We got some retracements, and eventually the market continued this movement, for days as well. So, in fact, what do I mean by days? For months, because this started around February, and the decline did not stop until around mid-April or thereabout. Right. So this is what we mean by global sentiment. So global sentiment can be used for swing trading, right? Holding a position for a number of weeks, expecting that things remains equal, and stuff like that. Right. So another part of what we use when we also want to create disparities between swing trading strategies and intraday trading is also the fact that even if you're going to use fundamentals, on your fundamental point of view, fundamentals can trade short term. Listen to this. Absolutely. You must understand that even though fundamentals is naturally thought of to be a long-term market analysis, you need to understand it could actually be short-term too. And short-term in what sense? You could trade intraday with economic data. Yes, yes. Some economic data could be traded as short-term. They don't matter too much, in the grand scheme of things. For example, on the US point of view, Joe's job opening is not something that will determine how the market will move for a long period of time. Whatever reaction we see at the time will be at the time. You get what I'm saying? On the US point of view as well, data like PPIs are not expected to determine how the market moves for too long. Data like retail sales, those ones, GDP, should not be the one to determine how the market moves for the next 1 month. So economic data could also be traded on fundamental point of view for, short-term trading, intraday trading kind of thing. But you see, when it comes to central bank decisions are purely, long-term. You can use that to trade, you know, swing. Or key economic data too. Key economic data like maybe NFP. Although NFP now, we've seen that NFP usually loses juice on Friday now. That's in recent time. Oftentimes we see that it actually still holds some weight for a while. But I mean, CPI also could be a major one because it plays directly into central bank decisions as well. And that's absolutely a side that we also need to consider when it comes to these two sides in the market. And also on a technical point of view, the time frame cannot also be the same. Right. So it means you cannot be doing short-term trading. And this is where I have problem. And I absolutely don't want to go too deep into it because I don't want to cause a problem. I don't want to cause a debate. But then someone is interested in doing intraday trading. He just wants to trade within the day, maybe using a particular sentiment he's seeing, or maybe using a particular economic data he's seeing. But then the first thing he wants to do, maybe because he watched a particular YouTube video, is he wants to go and start from monthly time frame. It makes no sense. And you might argue, oh, they said we should do multiple time frame analysis. I don't care. You're trading short term. You're only trading a particular recent information or a particular recent sentiment. You're working with yourself at the time. You need price action closer to you. Small time frames. Even the M15 I'm about to put, I am not comfortable with it, but I might want to say M15 to H1. But the best for me is the one in between, which is M30. And that's why every single time you come around for the virtual trading floor, you always find me on M30. The only reason I go away from M30 is if I cannot find any reasonable technical level in sight. If I can find one, I'm not going anywhere. Why? Because the kind of trading I want to do is strictly based on this particular information I've just read, and it says this. I interpreted it, it means this. I am supposed to buy this or sell this. I'm exactly on that time frame where I can see price action and make a decision. I don't have to go to dailies. I don't have to go to weeklies. What am I doing there? Except there is no technical level insight on the M30. If there's a technical level inside, I will stay there. If I cannot find one on M30, I go to the next best, the H1. If I go to H1, I cannot find what I'm looking for, then I go to H4. Not just immediately starting from daily and then you go down to weekly and then come on. Stay within your environment. M30 for me is the best when it comes to intraday trading. Like I said, for me, I didn't say for the market. Oh, because this market also is strictly based on opinion, which means nobody holds the universal language and nobody holds the universal opinion. For me and my trading, I have so much faith in M30 being a good time frame for short-term intraday kind of trading in the market. And if I'm going to be doing swing trading, and absolutely because swing trading is a mini long-term kind of trading, I'm dealing strictly with fundamentals, I'm dealing strictly with some, global sentiment or something, or central bank decisions or whatnot, then I absolutely need some key levels, which means I absolutely will need some higher time frames. And for me, even if I'm going to swing, I'm going to start from H1. You could swing H1 if you want, because swinging is of the mindset and the time that you're using to trade is not really a factor of the time. Do you know that I can swing on M15? I'm saying it with my voice reduced so that they won't say Mr. Emmanuel said he used to swing on M15. But let me tell you something. I could swing on M15 if I want. I could open a trade on M15 and refuse to close it till the end of the week. Who is going to hold me? Who is going to say, why did you take it on M15? It's bad. I mean, come on. I need you guys to be liberated from AI kind of learning and, robotic learning in the market. They said, who said? Who? Where's his badge? Who gave him the auditor of the market? I could go to M30 and take a trade and refuse to close it for the next 1 week. And I'll say, yes, I had a swing trade. Who are you to say that? Why did you do it on M30? I mean, please don't let us learn robotic markets. Don't let us be too rigid to the point where we take what is being said as the only opinion that counts. Even what I'm saying right now, another person will tell you what he's saying does not count. It's fine. You know you're listening too. But the idea that a particular time frame is strictly for this does not work for me. But yes, if I'm going to swing, I probably want to swing from H1. I don't want to get sold out with some, mini levels on the lower time frame. So I absolutely want to be on a higher time frame to see what works for me. But H1 to daily works for me when it comes to swinging, right? And H4 actually is the best, right? H4 for me is actually the best when it comes to taking a swing trade. Like I said, I keep using the word for me, right? For me, swing trading, H4 naturally is the best. For short-term intraday trading, I naturally think, M30 relatively resonates more with me in that particular light. All right, so I'm going to put them in brackets. I'm going to put M30 in brackets for, what's it called? Short-term. And then put H4. And this for me is my opinion. And here, key technical levels will work. Which means simple support and resistance could cut it here. Let me say key technical levels. For this one, you could work with simple, S and R, which is support and resistance. It doesn't even need to be too aggressive, really. But for swing trading, you cannot just pay attention to simple S and R. You absolutely need to be, much more, how do I put it this way? You have to be more concerned and focused with key levels, key slash, you know, psychological levels. All right. Absolutely. You need to pay attention to key, psychological levels when you're going to swing. Because a trade you want to hold on to for a week, you cannot enter anyhow, right? It has to be key level, a point where market can jump off, and you have to pay attention to key structures. Yes, structures are actually absolutely important when it also comes to, how do I put it now? um Swing trading. You need structures, you need break and retest, you need, you know formations, you need something that just gives you, so much confidence and so much, conviction that you could actually hold on to that particular direction, right? So that's absolutely some of the major differences you see that we have. And you see, one thing you would notice is that on both sides, there's what works for this side and there's what works for that side. And the interesting thing is, like I said, all you need to do is find what works for you. I've had people send me messages. I don't know how to, you know, do it. My work is so stressful. I don't have so much time. I have so much interest in trading. Is there any way I could learn how to swing trade? I've had personal requests like this. And honestly, for people like that, swing trading is the best thing for them to learn, where they don't have to worry too much about individual market analysis, taking too much trades, within the day, looking for short-term entry. They could just pay attention to one trade at the beginning of the week, lock it in, and have it there for the rest of the week. And this one does not have so much risk tolerance. This one is low risk tolerance because, naturally you won't be in a trade for too long if you know you're losing, because you're there, you're going to close it. But you see, for swing trading, you definitely must have high risk tolerance. That's the truth. Absolutely. And this is so funny because some of you want to swing, but you don't want to have risk tolerance at all. It won't work. It won't work. You must have high risk tolerance to swing. You must have high risk tolerance to swing. In what sense? For example, you go into the market, a very great level of support on H4, for example, and maybe you come and check in the next 4 hours and you saw that the market has pushed against the level of support you entered from, right? Which means you're currently losing. And on the market's point of view, on from the time frame you're watching, it looks like the move is so small. But then when you brought up your terminal, you saw how much you're losing. You're like, ah, I'm already losing this much. But you yourself, you can clearly see it on the chart. It's not gone too much against you. Yeah, it broke the level, but it's still within good environment where it could still go back above, the same point and moving in your favor. But when you see the amount you're losing, you're like, yeah, I'm losing so much money. I need to close this. Eventually, you close that, the market goes back above the level, pushes more, and then you can't get in again because you've lost the original entry. So you cannot say or claim to be doing, swing trading, but you don't have good risk tolerance. You can't. You must have good risk tolerance, and this one must have good risk to reward ratio. Well, at least for intraday, you need to maintain good risk to reward ratio, which means you absolutely need to check the level of, you know, stop loss you're using and compare it to reward that you can get. If you're going to get 50 pips, you have no reason to use 50 pips to stop loss as well. You probably need to get yourself maybe closer to maybe 25, half of that, which is 2 to 1 or thereabout. But if you're going to be doing swing trading, you absolutely need deep stop losses. I'll do some examples, right, and show you what it means, to do swing and then do normal, sentiment, short-term trading in the market. But you absolutely need some deep stop losses. You absolutely need some high risk tolerance. You need key technical levels, and you need to pay more attention to global sentiment and maybe even central bank decisions. So let's do maybe some examples. I have 15 minutes. Okay, let me see if I can do some examples before we go and just show you the thought process behind a swing trade or, a short-term intraday trade. So take, for example, let me think about a fundamentally, interesting pair that we could use as an example right now. I think for the dollar, it's that of weakness. Over time, we've seen some poor economic data releases for the dollar. NFP was more or less like a little bit better than expected. But nonetheless, every other data since that time has not been really good. We've had, CPI was bad, lower than expected. PPI was also bad recently on Thursday. It was lower than expected. We also had like four consecutive lower than higher than expected unemployment claims. We also had lower than expected ADP. We also had, ISM services PMI also was lower than expected. So quite a couple of negative economic data releases in recent times, which absolutely will pressure the dollar. Also, the fact that the president is calling for the central bank to actually, lower interest rate, also a negative. The old tariff debacle also is out of the window, also negative for the dollar. And if I'm putting dollar on the negative side, I probably need a stronger currency. And in form of a stronger currency in the market right now, we don't have too much, but we have some of them. I mean, for example, for pounds a little bit stronger from the central bank point of view. Also, the fact that the BOE is currently expected to hold interest rate unchanged. Also, the fact that we had some positive economic data releases recently. Although the last one was disappointing, I think with claim and count, but all things being equal, they've had some, interesting moves against the dollar. Also, the fact that CAD also had interesting moves against the dollar. Good economic releases in recent times. Job numbers were good. Also, the fact that the BOC is also currently expected to hold interest rate constant for a while. Shrimp CPI was higher than expected. So CAD also relatively is a good pair, a good currency to have against the dollar. And so I'm thinking pounds USD, I'm thinking, USD CAD fundamental point of view in terms of maybe, strong pairs to have against the dollar just in case. And I think maybe I can hold on to this particular guys, isolating the global sentiment point of view, just strictly fundamentals. And I'm thinking USD CAD, I'm thinking, pounds USD, I'm thinking pounds USD for a buy, I'm thinking USD CAD for a sell. And I'm thinking about how can I come in on a Friday or maybe on a Monday and get in and closing on a Friday, for example. And I'm going to their chart, thinking for pounds USD, I'm interested in buying, right? Because I have a clear disparity between the two central banks, and I absolutely think I could get in on some interesting buys. But then I'm looking at the 4 hours time frame on this particular guy, and the vibes of upside for quite a number of weeks in May was strong. I mean, in this particular time, the upside movement was quite strong. Clearly, market just having a go at the dollar and isolating this side, right? We can clearly see this particular upside push, for weeks. We had interesting upside push on pounds USD, and that works. But then, since that time, we've been seeing more struggles than expected on this particular asset, which means we've been seeing more up and downs, more up and down, more up and down, more up and down, which might mean that trying to swing this, hoping that we see a clear disparity between the pounds and the dollar might not be the right frame right now from what the technicals are showing. So I'm going to opt against this. I don't like the technicals not really showing us too much. So we're going to consider USD card, see if there's anything on there for us and see what we can make of that. And see, you can see what I'm doing. I'm not just entering just because I've been able to fundamentally back it up. I'm also looking at what the technicals are saying and how the chart looks like. I mean, that could be something, for a week. We'll still come back. I am actually isolating the fact that there's actually a trend here, but I don't want to just work with that right now, given the fact that the overall overview from what I'm seeing from here compared to what I had here is quite different, is why I'm pushing this off. And the fact that we're trading around peak highs, also one of the reasons why I'm pushing this off. So you must understand that. Let's just keep going. Let's see USD card. And USD card, interesting downside in recent times as well. Clearly, pushing lower, over time. I mean, we had some push lower, and we also had this interesting move, from this particular point right here. And I think this one also was really nice, clearly showing the disparity between the US dollar and the Canadian dollar between this was around 15th of May till about 21st of May. And that has continued, but prices have started to struggle right now in recent times. In the month of June, we've not seen too much disparity between them. Not so much, not so much, not so much, disparity between them in the month of June. And today's already June 12th, or just June 13 already. In the month of June, not so much has happened between dollar and the card. And if I'm going to swing for a week, maybe, but I don't think I'm also interested in the technical level as well. I think it's trading around key level of support. So not so much vibe. Let's look for another pair of interest. Canadian dollar still on the strong side, pound sterling on the strong side. Which currency can we put on the weak side again? Let's say AUD. The Reserve Bank of Australia did cut interest rate recently and actually did talk about potentially considering 50 basis point cut. Also, the fact that with the Iran-Iraq story, that could potentially be negative more for AUD. And I think it should not help pounds so much, but we've seen that pounds in recent times actually gets a lot of strength also from negative markets, same as euro. We might try euro AUD and try pounds AUD as well. See if there's anything on there for us to see. If there's anything to swing on there. I know the chart looks absolutely nice in that particular environment. Euro AUD, anything on the upside potentially okay. I think we might have some upside potentially on this one. All right, I think we're getting somewhere. And you will notice that from what I'm saying, I'm not picking random pairs. I'm picking pairs strictly based on differences and not just random differences, fundamental differences, and not just random fundamental differences, differences from central bank point of view and global sentiment point of view. That's the idea. Now, if I'm going to look for upsides on Euro AUD for like a week, and I can back it up with the fact that maybe the European, oh, good. Another reason why the euro is a good case is because the European Central Bank has declared victory against inflation, talking about the fact that there's only one more interest rate cut to come from the ECB this year. They're not cutting interest rate as much as we think they should again. And that's good for the ECB compared to what we're seeing from the RBA point of view. So absolutely, Euro AUD, good pair. All things being equal for a swing trade. Question is there any key level inside? Absolutely. Key level inside H4 time frame, break and retest, structure, inclined, absolutely superb. Swing trading in full-fledged. That's the idea. So here we have, right, key level, say, support multiple times, rejection here as well, support, have rejection here again, a support, and then eventually price bridges, retested it as a resistance, pushed it lower. We saw this particular retest here, pushed it lower. Now price is above. We've seen an original test already. This is the first test. And potentially a second one is also happening, has already happened, which means all things being equal, I could actually look to getting an upside from this particular point, hoping that the market continues to hold on to, a stronger euro against a weaker AUD, in the market. And I think I like the technical level, for example. And let me see. Yes, absolutely. Key test here. I mean, another one like a return, not an official test of this particular point. Oh, I would think we might get an official return to that particular point, but just in case, there's already been a test, and naturally prices should continue to go up. But even if I was going to have an entry somewhere around here, for example, for a swing trade to the upside on Euro AUD, or even if I even consider that maybe this is enough to get in on upside on this particular pair, right? For example, but I still think I might want to wait for this just in case, right? The question is, where would you have your stop loss? Now, that's a question. Where would you have your stop loss? Are you going to come here and come and measure 30 pips and say, 30, 35 pips here? Is that what you're going to do? You're going to go and measure 40 pips and measure 50 pips? No. Why? Because you must understand that, you see, the market can spend an entire day going against you on a swing trade. I'm saying this small because you need to get this. The market could go an entire day against you on a swing trade. Does not mean you're going to lose that trade. The market can use the next 3 days, recover all of those losses, and still go times 2 in profit. So I wouldn't let a small market moving against me rob me of the profit that I'm supposed to make, in a week. Which means the first thing of interest is, where is the next best key level? And then think about, right? So maybe there's a level here that just in case, listen, just in case, undoubtedly this is a key level of support, but nonetheless as well, this is also a key level of support. And listen to this end. On fee basis, this is 61.8%. This is 50.0. And from this point, right here, to even 50.0 is 45 pips. And then you want to put 30 pips, you want to put 40 pips, and market comes down to 50.0 and just pushes back again to the top and even more, but you're already out. No, this is also 61.8, which means there's likelihood the market could also potentially come down here and still get a renewed push from here and still go way beyond that high at that point. But you're already out. This means your stop cannot be anywhere within this bracket. If you're going to swing this, your stop cannot be anywhere within this bracket. You're going to, put your conviction on this fact that one of those support levels will push prices back up. Backing it up with why you think you should be buying from a fundamental point of view. Your stop cannot be there. Can't be anywhere within that bracket. Anywhere within that bracket. And the number of pips between this point and this point, maybe if you waited for it somewhere around here, is close to 89, 90 pips. Let's say at least 100. At least 100 pips must be your risk tolerance. At least 100 pips must be your risk tolerance. If you cannot live with that, then you have no business swing trading. Because don't forget, they said, if you are in Rome, you behave like what? The Romans. If you're going to join the swing traders, you have to behave like the swing traders. You cannot bend the swing trading to yourself. You will be the one to bend yourself to swing trading. You won't ask swing trading to bend to you now and say, please now, 100 pips is too much now. Can you just bring it down to 20? It's not possible. It's not possible. You won't ask swing trading to bend to you. You have to bend to it. If I'm going to swing this, waiting for a turn back to 38.2, if I get it on the buy, hoping to ride it for a week, your stop cannot be less than 100. Hiding it completely away from any swings within that particular box of 50 and 61.8. Completely. And guys, this is the funniest part. Those who are going to swing cannot be checking their trades every 5 minutes. You want to swing, you cannot remove your eyes from your chart or remove your eyes from your market, from your terminal or something. You're not ready. Why? Because you come now, you see -5, you come again, you see -8, you come again, you see -10. The next time you come, you're on -23. And you're like, this trade is wrong, is wrong, is wrong. Rather than losing the entire 100 pips, let me cut it now. I know the trade is wrong. I know. I already know the trade is wrong. I can feel it. So you now thought, thank God I even closed it. So I closed it at minus 23 instead of closing at minus 50. You see, I manage you did not manage your risk. You probably denied yourself an opportunity at winning so much more just because you kept watching and watching and you could not hold on. Okay. So another problem with swing trading is you cannot be there watching it 5 minutes. 5 minutes, you are there, you are checking. You want to see if it is going up. You want to see if it is going down. You want to see where it has gotten to. And your intention is to hold on to the trade for a whole week? No. You have to remove your eyes. Yeah, you have to forget it. I'm not going to say forget it completely, but you have to like mini forget it. But some of you do swing trading now. I'm going to enter you. Some of you have done swing trading unknowingly on demo accounts. Demo accounts that you know that the money is not your own. You enter trade. You are losing. You will not close it because you know it's demo. So you now remove your attention from it for like 3, 4, 5 days. You now come back and see it in profit. You now close it. You say, it's back. But you can't do it on your live account because you won't be able to remove your eyes. So if you're going to swing, your risk tolerance must be, must be very, very important. Very, very important. Where do you see central bank decisions? Usually Forex Factory has, central bank decisions on them. And also you could go to the official central banks of the central banks in the market. You could go to Federal Reserve website. You could go to Bank of Canada's website. You could go to Bank of England's website. You can go to, the Swiss National Bank website. You could go to quite a number of websites, in the market, absolutely, to check their decisions and also try to follow Forex Live as well. They also have something for you when it comes to central bank decisions. All right. If I was going to do, intraday trading, I wouldn't have to do too much thinking about central bank decisions, long term, what's it called, fundamentals, or even if there's anything from global sentiment. I might just pay attention to what, the stories in the market is in today, what sentiment is saying. So another example for, the other example could be in the case of, what's it called? Just a simple, intraday kind of day trading, which is what we do every day on the virtual trading floor. That's more or less like intact intraday, reading information, seeing what information is saying, looking for something to trade. So a random one could be, for example, just looking out for, simple, strong, and weak currency, what sentiment is saying. Sentiment is currently neutral at best. Strong and weak currencies. We're seeing some dollar strength in the market today, but I don't think it's by too much anymore. Let me just check how many percent. This is about 60, 0.60. This is about 0.58. SLD USD is going to be a good pair, but honestly, it isn't because we already checked it to the virtual trading floor this morning. It's quite scratchy, as the case may be. View, market watch, NZD USD, except if a miracle has happened on 30 minutes time frame, quite scratchy, markets are moving lower, but the movements are not entirely encouraging too much. I mean, yes, we're seeing some downsides happening, but not entirely too encouraging for me to be interested in trading. So in terms of intraday trading right now, we're probably a little bit more skeptical because the story is there. The Israel-Iran story is there, but the market is not reacting, accordingly too much, from what we're seeing. There's so much struggles in the market right now. Even if I was going to look for an opportunity to get in on some, downside on NZD USD, trying to pair up strong currencies against weak currencies, as the case may be, I still have to look at what the technicals are saying, and the technicals are just saying, look at this. I mean, come on. It's just, it does not give you so much good vibes. The technical levels are not there. Quite messy movement, as the case may be. I mean, we've got an official test at a particular level of support right here, but see what you have, right? So And trading is not just about trying to play out something, it's about also seeing if it actually even makes sense for you to do that particular thing. So in terms of if I could, do an intraday trade right here, I don't think so. You might think, yes, the structure look good, but I don't like the overall structure, and that's M30. I didn't go away from M30. I didn't change my time frame. Even when I shrunk the market to see a better view, I never changed the time frame. I just shrunk my chart and I could see overview from as far back as 1st of May. I didn't go to any higher time frame. It's still M30. You could do everything you want to do from M30 if you're doing intraday. So, I mean, you could think, okay, maybe we had this year and we had this year, for example, and you feel like, okay, so maybe this could also, just usher in another downside from somewhere around here as well. I mean, it could happen based on the structure that we've seen, right? It could absolutely happen, isn't it? Because we also had this before we saw this move right here, right? And we could actually say, oh, the market could absolutely continue to go down as well. But maybe I don't have too much confidence in it. But this is how we do intraday, right? Trying to make do of what information is currently available to us in terms of sentiment, in terms of headlines, and also what we have in terms of strong and weak currencies. And this is what we do every day on the virtual trading floor. And as you know, you're always there. So this is something that you're absolutely used to. I think the swing part is probably the only one that you might not be entirely used to. And absolutely, this is what we have for you in the session today. It's past one. So we have to take questions and answers now so that we can close in the next few minutes. I already answered what this person asked. How do you see central bank decisions? They don't come out every time as well. It's usually once in 6 weeks, once in 2 months. What we usually do is make inferences and we will do what we call pricing. So the market prices in central bank decisions ahead of time using economic data or preceding economic data and event. What is different between swing trading and future trading? I don't think there's anything called future trading. I think what we have is either futures, except you remove the S. Futures, and futures are these assets with .f, except that's what you're talking about. I'm not sure if there's anything called future trading per se. I don't know, maybe it's a new term or a new language. I'm not sure if I've seen that before, but equities like US 500, have a .f on it, and that's futures. Futures, and it does not mean tomorrow. It's not like saying, am I seeing into the future? No, no, no. It's because in the market, we have what we call spot contract and futures contract. For example, there's another US 500. Yes, this is US 500, US 500, and indices, but you can see that's .s. .s means spot contract, and .f means futures contract. Not it has nothing to do with swing trading or intraday. You can either swing on it or intraday on it. Which bank decision drives gold? Not necessarily a bank decision. No, there's not necessarily any bank decision, that drives gold per se, but any central bank decisions, especially from China and from the US, might play a major role for gold, but not directly. All right, not directly. Okay, not directly. Gold is not really a currency; it's an asset. So you don't expect that it is majorly driven by, any central bank decision. But when the Fed, makes up policies or something that affects the value of the dollar, because of the relationship that we know to exist between the US dollar and gold, it will be moved, right? But not necessarily because gold is affected by central bank events. All right. So which one pays between swing trading and intraday? From my own point of view, I hardly do swing trading. All right. So let me start from my own point of view. I hardly do swing trading. Why? Because I'm available every day to trade. I'm a market analyst and I'm a trader, which means my job every day is to analyze the market, see what's available in terms of information, see what could be traded, do market analysis for my clients and everything. So I'm available for everyday trading. So I do mostly intraday trading. I hardly do swing trading, all right? Except if there's a reason or an asset that I think I want to hold on to for a long time. Yes, I might have them once in a while, but because I have time on my hand, I tend to do more intraday trading, looking for opportunities as soon as they come. But from your point of view, it has to be based on, like I said, when I introduced the session, what works for you? right? It has to be based on what works for you. It can't be based on what I'm telling you to do, and I cannot choose for you. A lot of people are profitable as swing traders. A lot of people are also profitable as day trader. So I really don't want to say, oh, you have to be a swing trader, or oh, you have to be a position trader or this trader, but you can try out both sides. You could decide to open a cent account, with your already live account. Maybe you're already doing intraday. You can decide to open a cent account and use it to try out swing to see if it's something that you like. You could actually do that. You can make an objective decision. Absolutely, it works, right? It works. And if you are someone that doesn't have so much time on your hands, your work and your business requires so much hands-on experience, then you might also want to consider swing trading. So I don't think it is the same for everybody. I think the ball has to be, what circumstances you have for yourself. Have I closed my AED JPY? I've actually not even gone back, as Sam. That's the interesting part. I've been busy since I finished that session in the morning. But once again, I don't think I want to say that on recording. Anyway, but once again, we're in ABBA tomorrow, right, for seminars. So we're currently preparing for that. So hence why I've not even gone back to check, on that particular one. I'm going to check now and see what's going on there. There's no economic data that drives gold as well. Gold does not have an economic data. It borrows. And economic data that drives dollar would then drive gold. So it's not like maybe gold has any economic. So it's not like maybe gold has its own economic data. It doesn't. It borrows. It borrows from the dollar. Whatever affects the dollar would also affect, gold prices as well. And gold swings are usually interesting to me. Gold swings must be, usually on weeks where there is, quite a strong dominant market sentiment, especially geopolitics. You could do some gold swings on that particular light. But the problem is, that on gold, 100 pips will not be your stop loss. So, you know, you know that absolutely on gold, 100 pips cannot be your stop loss. 100 pips is a stop loss for someone that is even doing intraday. Talk less of you that wants to do a swings on gold, for example. So, cannot be the same. On gold prices, let's say if I was going to do an intraday, I mean, the market is struggling around this point right here. So let's say we might not be able to get in somewhere around this point. Is there any other key level inside? I might think in terms of key levels, maybe this, right? Being a level here, here as well, then a test here as well. There's one here, but it's mid. I'm not sure if I really like this one. I mean, it's there, being a test one here, but in terms of key level, maybe this one is probably better. If I'm going to get in somewhere around here, your stop has to be away from this point entirely. Now, imagine trying to come in somewhere here and trying to have a stop, completely away from this other level of support somewhere around here, for example. You think the number of people between this place and this place is 10 or 100? Almost 700 pips. Almost 700 pips. So gold swings are not a joke. They are not, they're not a joke. They are not a joke. I promise you, they are not a joke. They are not a joke at all. Good swings, not a joke. And so I'm not really doing too much about that. All right. — 139. Let me see. 139 k or 149. It can't be 139. 139 is so far. Has this probably made a mistake? 139 here? No, now. The market cannot. How would the market just get here out of nowhere. That's almost like 400 pips away on a currency market. No, that's much. I'm not sure if market can get there in a week. It's too much. But yes, maybe downside on USD JPY could absolutely be something on the technical side. Even on fundamental basis, you might think the JPY and the dollar, they're not far off right now. The BOJ is talking about not hiking interest rate for long or not having a pre-part to hiking interest rate. That's actually negative for the JPY. On dollar side, also some negative. So the question will be, which one is a lesser evil on the technical point of view? Also, the fact that we might potentially be having if I isolate this side now, we might be having like an head and shoulder pattern on this particular price right here. And that might just give us some much more maybe inclination to some potential downsides. For example, I don't know, but it looks like we have a peak point somewhere around this point here. Then we are seeing this again and we're seeing this move. And we might happily be able to have some downside, but I don't think you want to have a TP here in a week. I'm not sure. I'm not sure. Maybe if at most, maybe somewhere around here, maybe around 141, and that's a key level of support that you should be looking to come out from. So yeah, maybe you could have some downside, maybe. All right. So I mean, this is what we can take in the session today. Thank you guys for joining us for another interesting session. The video to this particular recording will be available on YouTube later. For those who joined late or for those who might want to rewatch, we're going to be happy to have this for you on, the YouTube page. Thank you for your time. Thank you for joining. My name once again is Emmanuel Olalikon Akinola, market analyst at HFM Nigeria. Please enjoy the rest of your afternoon and bye for now.